Good afternoon. Welcome to Web Chat Wednesday at Emory University's Goizueta Business School. Today we'll be doing a finance mock class with Dr. Raymond Hill. I encourage all of you to submit questions throughout the presentation, and I'll do my best to answer them to Dr. Hill on air. Before we get started, I will introduce our instructor. Dr. Raymond Hill joined the Goizueta Business School in 2003 and teaches managerial economics and finance. He began his academic career by teaching economics at Princeton University before leaving in 1982 to become an investment banker with Lehman Brothers. His work at Lehman included a 7-year stay in Hong Kong as managing director of its investment banking services in Asia outside of Japan. Dr. Hill returned to his native Georgia in 1993 and served as chief financial officer at Mirant Corporation, a global independent power producer and energy marketing and risk management company. Dr. Hill earned his undergraduate degree at Princeton and his PhD in economics from MIT. With that, I will turn you guys over to Dr. Raymond Hill.
Thank you very much, Nicole, and welcome to, I would say good morning or good afternoon, depending on where you're living. What I'm going to do today is talk about some material that I would cover in the core economics course that I teach. It's going to be a little bit different from the actual course dynamics because I'm used to asking questions more or less incessantly of the students as we go through the course, and they in turn ask me a lot of questions, and we're only going to get about half of that today. I can't ask you questions, but I would really encourage you to send in questions to Nicole as we go through the material, and so we can make this at least a little bit interactive. So you see in front of you the title, Price Determination in a Competitive Market. But let me just go to these takeaways that I really want to cover today. The first you're going to find maybe a little bit odd. Is a supply curve just a line in a graph in a textbook, or does it have any practical meaning? And I've stated it this way because part of what I want to do today is give you a flavor of the difference between an undergraduate course in economics and the kind of the way we teach economics here in the business school. So all of you know, you've heard the guy on TV or in the radio talk about some price change, and he said, oh, it's a matter of supply and demand. It's very vague, and none of that means anything unless I can actually quantify what I'm doing. It's useless to me in a business sense, and that's what we want to get to today. That's going to lead us to the main question: how are prices determined in a competitive market? That's going to allow us to also look at this. People come into business school or in business generally, and they think that, well, if I'm going to price the product I sell, surely what I want to do is cover my costs plus some profit margin. And what we're going to see is that firms don't always charge a price that covers their costs. And we'd like to know why that is, why it makes sense for them not to do that. And then finally, what we're going to do, we're going to talk mainly today about electricity markets because they have some very interesting properties, but then we're going to get some insights and then turn to another market, so the world oil market, and I hope those same insights help us understand not only what's happened in the past, but maybe also some insight into what may happen in oil markets in the future. So as I said, we're going to use as our sort of case here electricity markets, and you've got a slide in front of you that shows the various components and the vertical structure of the electricity business. What we're going to do is we're going to focus on the left-hand side, which is power plants. They represent about sort of half the value chain. And the reason we're going to do that is because many power plant owners can connect to a single grid, and that gives the ability for us to have a competitive market in electricity generation. On the other hand, if we look at the right side, we're talking about basically a set of wires that takes the electricity to your home or to your business, and we only need one set of wires. So this part of the business is typically under the domain of some regulated monopoly or another. So again, we're going to look at the generation side of the business, the power plant side. And the first thing I want to do is sort of show you where these markets exist. So you've got some maps here. You can see the United States there. Turns out that about one out of, I would say about 60% of American consumers ultimately buy electricity that originated in a competitive market. We've got some big concentration of population areas, even though the geographic spread doesn't look that great. And then you see Canada has some competitive markets, and then there are a lot of countries around the world that have adopted competitive electricity markets. And a number of them did that well before the U.S. had competitive markets. So we're not the innovators here. We're up to speed, but we're certainly not ahead of the pack in that respect. So a little background on what these markets look like. The first thing we'll note is that they're all regionally based markets, and that should be blindingly obvious. If I want to sell electricity, I have to do it through a wire system, a grid, and the grids are all regionally based. I can't take, let's say, my excess electrons and put them on a boat and send them to Europe. I've got to send them through that regional grid. Almost all these markets are based on daily auctions. So today there'll be an auction in each market where people are entering bids to buy or sell electricity in tomorrow, and usually the bids to buy or sell are divided into half-hour or hourly increments for the next day's energy production and consumption. And then who are the participants? Well, the first are large energy users. So think about, let's say, a paper mill that consumes a lot of electricity. But then also could be somebody like, for example, in New England, Harvard University is a participant in the wholesale market there because they actually have a great big electricity bill. The other buyers are the companies that you actually might be familiar with, the utilities that have wires that come to your house, and they'll typically in these markets be buying electricity in the wholesale market and then redistributing through those wires to your home or to your business. The sellers are power plant owners who want to sell their output into the market. But increasingly these days in these markets, there are also sellers who sell what we call negawatts, so negative watts, and they're selling a product which says that they'll reduce their demand whenever their peak demand goes very high, and that they get paid for avoiding having to build a new power plant. So we've got both positive sellers and negative sellers. And then we have financial traders, and they're of all sizes and types. So Goldman Sachs, Morgan Stanley, for instance, are very active in these markets. And these financial traders also are designing financial derivatives to help either the users or the sellers hedge their financial risk as well. So that's what the market looks like. We're going to start by making up a hypothetical market. So one that we can sort of look at in detail. And we'll say this is, for example, the country of Mulvania. Okay, small country, and we've gathered all the information about all the potential market participants in this market. And you can see here on the left, we've got all the potential producers, A through J. We've got the quantity they're able to produce. These quantities are expressed as megawatt hours. Don't have to worry about if you don't know that nomenclature, but it just gives us the units at which we're going to sell the electricity. So A is capable of selling 210 megawatt hours of electricity. The fuel cost is the variable cost of producing that, and so that $49 represents the cost for A to make 1 megawatt hour of electricity. And then we've got some capital costs, fixed cost. And what I want you to notice about the graph on the left is that we've got different costs, and that reflects a number of factors. One is that these plants were probably built at different times, and the newer plants are more efficient than the older ones, so they burn less fuel per unit of output. It could also be that some of the plants spent a lot on capital costs, which made them more efficient in terms of marginal variable costs. Some that spent less capital cost. And then finally, they probably burn different fuels. So some burn oil, some burn natural gas, some burn coal. So there's a reason why they all have a different cost as well. On the right side, we've got the potential buyers in this market, and that's described as willingness to pay. And you can think about that as a reservation price for each of those consumers. So K, consumer K, let's suppose that's our pulp and paper mill, and they're willing to buy at a high price because they want to keep in operation. But at some price beyond $59, even they will say, look, we're just going to take the day off, shut down the plant, and we're not going to buy electricity. Down towards the bottom, you may have, let's say, a distribution utility buying for its customers. And maybe those customers are saying, hey, you know what, if the price gets too high, I'm just not going to run my air conditioning very much, or maybe turn off my air conditioning rather than buy in that market. So we've got a schedule here of willingness to pay. Electricity is not very price responsive, but there is some price responsiveness. And so we've got all this information, and what we're going to do is ask the following question. What is the market clearing price in this market? We'll say these are all the potential buyers and sellers that are going to enter into the auction today for delivery or purchase of electricity tomorrow. What will the price clear at? Now, you may look at this and say, well, gee, how am I going to find that out from all this information? But I want you to think for a minute. Suppose you were in some industry and somebody handed you the production cost of every one of your competitors, and they also told you the willingness to pay of every consumer in that market. You would think this was pretty valuable information. You never have that kind of information. So the question is then, how do we convert that into something you could use in a business sense? And in particular, suppose I wanted to predict the market clearing price tomorrow, what would I actually look at? Well, on the right side, we've got something that really looks like a demand curve, right? It's the willingness to pay and the quantities that each consumer is willing to pay. So let's concentrate on the supply curve. So you've seen supply curves, even if you've taken the small amount of economics, all right? They're drawn on a graph. And you've heard everyone say prices are determined by supply and demand. But I want you to think for a minute and ask yourself the question, when I draw that supply curve, exactly what does it represent? And in particular, if you're in a business context, you want to say, if I had to populate the curve with numbers, what numbers would I go and collect? And what numbers would I put on the graph? If I can't do that, then it's pretty much just a sort of useless concept. Nice maybe to know something general about markets, but it's not a very useful practical tool in business if I can't somehow quantify what's going on. Now, you might tell me that the supply curve represents the willingness of each supplier, of each producer, from the lowest to the highest, to sell its output in this market. And that's a great textbook answer, but it still doesn't answer the question of, well, what determines their willingness to sell? What number do I want to collect that will indicate what that is? Well, I'm going to assert that it's the marginal cost, that the willingness to sell is represented by the marginal cost of each supplier in this market. Now, you don't have to believe me yet, okay? Just let me go with that assumption for a while. You might be saying, why is it the marginal cost? They have some other costs as well. Why isn't there full cost? Well, again, we will get back to that in a minute. But for the moment, just take it on faith, if you will, that it's the marginal cost of each supplier. Okay, well, what's the marginal cost? That's the cost of burning the fuel to produce another unit of electricity. It doesn't include those fixed costs because I spent those on building my power plant some years ago, okay? So I'm going to rearrange the information that we had from the previous slides, and I'm going to now represent as offers to sell in this auction that we're conducting for power tomorrow, only in terms of the variable cost or the fuel cost of each producer. And you can see what I've done here. Now I've re-ranked the producers so that I've got the lowest marginal cost producer at the top and then increasing marginal costs as we go down. On the right side, before we said that was willingness to buy, okay, I've converted that into a bid to buy because this will represent the bidders' prices in this market as we go through the auction. And again, you may pause and you say to yourself, well, wait a minute. I understand that K was willing to pay up to $59. Okay, that was a reservation price. Is it clear that they would bid 59 just because they're willing to pay that high? And as we'll see in a minute, the answer is yes, because in an auction market like this, or any competitive market, one price clears, and everybody who sells gets that price no matter what they bid. Everybody who buys gets that price regardless of what they bid. So K can be confident it will bid 59. If the market clearing price is lower than that, it's going to get the market clearing price regardless. So let's see how this would work. Okay, we said this is an auction market, so we have an auctioneer. In these real markets, you can think about that as somebody sort of like the New York Stock Exchange. They're called independent system operators, and they actually run an auction process to determine what the price and the quantity is going to be for tomorrow. So what do they do? Let's start out. An auctioneer calls out a price. So our auctioneer calls out a price, $46. Who's willing to supply electricity at a price of $46? Well, there's only one guy who's going to do that, and that's I. One power plant can supply at $46. Who's willing to demand? Well, everybody is willing to demand. You can see that we just add up all of these demands here. They're all willing to demand at a price that is lower than 47. So now we have a huge imbalance between supply and demand. What's our auctioneer going to do? He's going to say, well, I'm going to raise the price. If I raise the price, I attract another seller into the market. I still have the same number of buyers because everybody's still going to buy at 47. Okay, so the auctioneer says, I've still got an imbalance. I'm going to raise the price again. I get another seller willing to come into the market. And now buyer T says, well, I'm dropping out. I'm going to turn off my air conditioning. I'm not willing to pay a price of 47 in this market. So we've closed the gap a little bit, but it's still pretty substantial. So the auctioneer keeps raising the price, okay, keeps attracting new supply. Okay, if he raises it to 51, get new supply, and he knocks out two other consumers, all right? So we're narrowing the gap. And when we get to a price of 52, what happens? I've got 1,100 megawatt hours of supply. I've got 1,100 megawatt hours of demand, and the market has cleared. So for tomorrow, everybody who is demanded is going to pay a price of $52. Everybody who has bid into the market as a supplier is going to get a price of $52, no matter what they bid. And then we see that there are some consumers and there are some producers who didn't clear in the market, so they are not going to participate in tomorrow's market. So that's the auctioneer process, okay? And that's how it would really work for these markets. But now I want to present the same information in a format that might be more familiar to you, okay? So I can do the stack all of the demand bids and supply bids in the way I've done in this graph, and now it starts to look like the supply curve and the demand curve that you would have seen in the textbook, all right? Increasing supplies in the red from I, E, D, and so on, and then decreasing demand prices in the same way we looked before. So what's the point here? The point here is that you draw those supply and demand curves, but you should think about them as representing a set of sellers who are competing to get into the market and a set of buyers who are competing to get what the market has to offer. And the mechanism looks very much like the auction process that we just went through. Okay, so we've got the market clearing price. We answered that question. But if you remember, we did that because I said that the supply curve was the marginal cost of each producer, and that allowed me to construct that supply curve. And let's go back and examine that assertion, because, again, you might say, why is it just marginal cost? I had some more costs in here for each of these producers that I had to cover. So I'm going to go back and look at generator D, okay? And we'll repeat the same information that we started out with for D. So he had 150 megawatt hours he could sell. He had a fuel cost of 48, and then he had this capital cost of $11. And we want to investigate, where did that come from and what does it represent? And the key thing here is D, remember, received $52 like everybody else in the auction, but their cost was $59. why were they willing to live with that outcome? Okay, let's go back and first answer the question, how much money did bidder D make in addition to the marginal cost, in addition to the fuel cost? Again, he got $52, his fuel cost was $48, so he made $4 for every unit, and he had 150 megawatt hours to sell, so he made $600. Okay, so he made more than his variable cost. However, it cost something to build D's power plant. Might have happened several years ago, but let's suppose bidder D had spent $6 million to build the power plant 5 or 6, 7 or 8 years ago. It was a one-time cost, okay? Well, where did the money come from to build that power plant? Well, D had investors, shareholders, okay, and they invested in D because they, not out of charity, they were expecting to earn some return on their investment. And let's suppose they expected at the time they invested in D, gave them the money for the plant, that they were going to earn an annual return of 10%. Right. If it's easier, you can think about this as D borrowing the money from a bank and paying 10% interest. But some way or another, they got the financial capital to build the plant, $6 million, but they got it in exchange for an expectation that there would be a return on that capital. So let's look at this. 10% per year times $6 million means they've got to come up with $600,000 to make their investors happy, or let's say to pay the interest to the bank. And we're going to divide by the number of days in a year. So they got to come up with $1,644 a day, okay, to cover their cost of capital. We can look up at the top. It's not as much as they actually made. What's going on here? All right. And I'm going to do one more thing. We're going to take that 1644, which is the total amount they need, divide it by the number of megawatt hours they have to sell, and that's where we got our $11 for. So we would say that their $11 per megawatt hour represents the fixed cost per megawatt hour of supplying electricity out of their power plant. So we know where the numbers come from. Now let's ask the question. If it costs D $48 of fuel and $11 of capital cost, or $59, why in the world did they bid a lower number in the auction? Why did they bid 48 instead of 59 if 59 was the number that they needed? Okay, well, let's go back and look at the outcome of the auction. Okay, so here's the same slide we had before. And we can ask the question now, what would have happened if D had bid $59? How much money would it have made? And the answer is nothing. Why? Because it would have gone to the bottom of the stack there. Look at producer F. Producer F also has some capital cost. The way the market cleared, F got no return of its capital cost, okay? But if D were foolish enough to bid 59, F would be happy to take their place in the stack and make a little bit of money by selling into that market. So the choice for D is not, do I bid a price that will return my capital costs? It's, do I bid a price that will give me the best chance to get some money back to pay back my capital cost? So D built the plant a while back. That's already happened. That fixed cost is sunk. All right. The investors would like to get $11, or the bank would like to get $11 of interest. But the question D has to ask is, which is better? Does it get that $600 from operating, or does it get nothing? And the same thing, we'll ask its shareholders, look, I can't give you the 10% return. Would you rather have $600 or nothing? Or if it's borrowed the number borrow the money from the bank, even the bank would rather say, well, give me some interest, rather not. Now, we've got a question that I'll just go on. What about the principal amount of the fixed cost? Okay, so I've said we're going to get a 10% return on that money. And I'm oversimplifying a little bit here, but the way I'll answer that is if investors in a company get a adequate return on the money they put into the company, they're not looking to get their original investment back because the company basically is going to last forever. So think what happens when you invest in, let's say, Apple, okay? You look and you say, what kind of dividend do I get, or what is the cash flow that I'm going to get out of that investment? You basically don't say, well, I spent $160 a share on it. When are they going to pay me back my $160? You're content to leave that $160 in the company forever as long as you're getting that return. So I hope that's an adequate explanation. So again, what we're back to is in this market where I have other producers jockeying to get some of their capital cost cover, a producer wants to bid its marginal cost, not because that's going to make its investors as happy as they thought they might be, but because it's going to give them the best chance of earning at least something to return their fixed cost. They're never going to bid below their fuel cost. That would be foolish to bid below variable cost, but they're going to bid as low as they can to give them the absolute best chance to earn some money. All right, so that's fine, but let's go back to this. That tells us why the supply curve is the marginal cost, the fuel cost. But I hope you're still thinking here, well, wait a minute. All these companies had a fixed cost as well. And surely all of them, when they actually built the plants, when they got the money from investors, had in mind that they would somehow recover that capital cost. So it begs the question then, if everybody is going to continue to bid their marginal cost, how do they recover their fixed cost? They must have expected to. So what did they expect to have happen? Now, it's interesting. Before I go on and explain that, we've got a question, is this predatory pricing? And the answer is not at all. This is how every competitive market in the world works. I'm sorry to say this, but when I go out and I say, gee, it cost me this amount to offer this product to you, Mr. Consumer, consumers are quite happy to say, I'm going to buy from somebody else at a lower price, okay? Now, let me go back, and I'm going to have another question that comes in, but I want to go back to this question of how they're going to recover the capital cost. So let's go back to our supply and demand curves that we have here, okay? And what I'm going to do is I'm going to put a little rectangle next to our cheapest marginal cost supplier, I. His fuel cost is $46. Remember, he got $52. So that rectangle represents the amount of money that I got in addition to his fuel cost, okay? His sort of operating margin, you can think about it that way. And we'll put a little box over every one of these producers, and it represents the difference between what their costs were and their price times the amount of output they had. Well, we call these margins, if you will, the producer surplus. So each of these guys who cleared in the market has a producer surplus, and that's the amount of money that's available to give them a coverage of their fixed cost, to compensate them for their fixed cost. Now, as we saw, for D, and maybe for all of these producers, they would not have recovered their full fixed costs. So D sitting there, we know that that box was not big enough. But we said that this auction is taking place on one day. And let's suppose it's a day in April, okay? April, the demand for electricity is not very high. People don't have a big cooling need. They don't have a big heating need. And the result of that is that prices are low. Let's fast forward and suppose it's August, okay? Let's fast forward and suppose it's February, where the electricity demand would go up a lot. Well, this demand curve is going to shift up when we get to August, okay? And when it shifts up, all of these boxes of producer surplus are going to then go up as well. So when D built their plant, we suppose that they're thinking a very complicated question is nobody's guaranteeing me that I'm going to get my fixed cost back. The recovery of that fixed cost is going to vary as the demand curve shifts around. I'm going to hope that over the course of a year, I get that whole, what did we say, $600,000, our whole $11 it averages out to be, but nobody's guaranteeing that. But I have to make a complicated assessment of how this market's going to work. Now, I'm looking at a screen. I'm up to question 5, but Nicole, is there possibility of going back to question 4? Because I don't see it on my screen. You there, Nicole? All right, well, I'll keep going. Nicole, if you can find question number 4.
Question 4 was actually about clubs and activities that would help students learn more about the financial concepts that you're talking about today.
Okay, well, let's go back to that at the end, okay?
Sure.
And question number 5 is, how would a company recover its capital costs? That's just what we're talking about. It is hoping for that demand curve to produce enough producer surplus. All right, so we've been talking about Moldavania, this made-up country. But now let's go to a real supply curve. Okay, so this is the supply curve for electricity in New England during the summer of 2006. And we've color-coded all the different types of producers. They have those different costs that we talked about before. So start here on the left and look at hydro. Hydro doesn't need any fuel. I just put the water through it, so its marginal cost is virtually zero, okay? And if we look here, I've drawn a dotted line here, which is where the demand was on a very hot day in the summer. And so we can infer from that where the market price was during that day. We draw a line across here, okay? It's where demand intersected with supply. And that allows us to see that the hydro plant earned a lot of producer surplus on that hot day in 2006. Well, that makes sense, okay? Because the hydro happens to have a high capital cost. It costs a lot of money to build a hydroelectric facility, and the hydro facility must have been counting on getting a lot of that producer surplus in this market. Okay, we can look at some other things here, okay? For one thing, we can see that these plants that are red here are all oil-fired plants, and we can see that at this demand, they are like the plants we saw in the Moldavanian example. They didn't even run. So why are they even in this market if they didn't run on this hot day? Well, the first thing we want to note is that these plants are all old, 40, 50-year-old plants. And when they were built, they were probably the most efficient plants in the system. But as they got older and other newer, more efficient plants were built, they migrated up the supply curve. Second thing we can ask is, well, okay, but if it's a very hot day and they're not running, why are they there at all? Why don't those owners just go away? Well, remember, the plants were built, the capital was committed in the past, it's sunk, all right? They're sitting there saying, well, maybe in February or maybe next summer, there'll be some really hot weather, the demand curve will go up, and I'll actually be able to earn a little producer surplus. I'm not going to buy the fuel. I don't have to until I know I'm going to run, but it doesn't cost me anything to sit and wait in this market. A couple of other things. One of the reasons these firms got pushed out of the supply chain or up the supply chain were these blue firms here. This is the marginal cost of all of the gas-fired plants that are relatively new in this market, have been built in the last 20 years, okay, with lower variable cost. And they have pushed the oil plants up the market. You can also look here. This tan is coal-fired plants. Okay, and at this time they were earning a good bit of producer surplus. You can see the gap between the market price and their marginal cost. Again, they are very capital intensive, so you'd expect that. But look at this plant. This is Mount Tom in western Massachusetts, and it closed down last year. So this chart is 2006, 2017, Mount Tom went out of the market. Why? Well, these gas-fired plants, this isn't the fuel prices of 2006. As you're probably aware, natural gas prices have fallen tremendously since then. And the result is that this blue area fell. Mount Tom, on the other hand, being a coal-fired plant, had additional environmental costs, so its marginal cost rose. And Mount Tom, again, moved up the stack like these red plants, and its owners basically said, look, we're never going to run again. The gas-fired plants are always going to be less expensive. We're going to close down and exit the market. And that's exactly what you would expect to see in a competitive market, that the newer, more efficient plants drive out the ones that are older or less efficient. Okay, so It's an interesting question. I have somebody here saying, I think airlines also price to cover marginal costs and hoping to recover their capital costs. Well, there's a famous quote from Alfred Kahn, who was the architect of the deregulation of airline markets, and he described airplanes as marginal cost with wings. Okay, so that's a good point. Now, I want to go on to the next slide, which is a picture of another real supply curve in another real market, okay? In this case, we're talking about the Texas electricity market, that little acronym ERCOT, that's what we call the Texas market. And every one of those little dots, the triangular dots that are blue, represents the marginal cost of every plant in Texas in 1999. Every orangish red square represents marginal cost in 2000. Now, what we're going to notice here is that there's a vertical part of this 1999 supply curve that rises very sharply. All we have are very expensive plants if the demand were to reach that high. And I don't know what the demand curve in Texas looked like in 2000. I'm going to just draw something in, but I do know that it crossed the supply curve at an average price of about $40 a megawatt hour. I could observe that as the market clearing price. So that's where the demand curve must have been. Now let's think about this. Suppose I'm in Texas and I'm thinking, should I invest in this market? Well, Texas is a vibrant economy. It's going to grow. Demand curve is going to shift out. Okay, wow, if I build a power plant, next year the price of power is going to be very high. I think this is a good place to invest. I'm going to go ahead and build a power plant. Now look at the red, okay? That's what the supply curve actually turned out to be next year. And what you can see here is the market clearing price was actually lower because the supply curve had already anticipated that rise in price, and people were already building power plants in anticipation of a price rise. So it takes about 2 or 3 or 4 years to build a power plant, and this high price never materialized because in a competitive market, people aren't waiting for the price to get there. They're making projections of what's going to happen in the future, and that's what happened. Okay, I got some more questions here, but I'm going to come back to those at the end because they are interesting questions. I want to cover them, but I want to look at this first. So again, the lesson here is I don't have to wait in a competitive market to actually see the price appear. People are already making complicated forecasts in advance. All right, so we've got this idea now about how competitive markets work. Let's turn our attention to another market and see if we can use these same tools or concepts to see what's going on. The market I want to look at is the oil. So this is the price of a barrel of oil. And I've adjusted it for inflation, okay, which has the effect of actually you can see these wild swings. The swings would be even wilder if I hadn't adjusted for inflation. And you can see here we've got the first oil crisis when OPEC constricted supply in the mid-70s, another oil crisis in the early 80s when OPEC further constricted supply. So we had the prices shoot up. And then we had this long period of very low prices, okay, almost 2 decades. And you might be curious about this. You could say, well, if they have volatile oil prices, I can understand why it might go from very high to very low, but wouldn't it bounce back up again? Why did they stay low for so long? Well, in order to answer that question, you've got to think about, guess what, the supply curve. What was the market response? So look again here. You've got very high prices in the early 80s. People then said, well, how can I get some more oil into this market to take advantage of that high price? And one of the things you should be aware of, we're never going to run out of oil. We've got plenty of oil in the Earth's crust, but a lot of it is very expensive to get out. And so we basically say we'll extract some, but we're going to leave that other oil in the ground because it's just too expensive to extract. Well, what people began to look at in the early 80s was, what have we passed by in the past where we know there may be oil, but it has been too expensive to extract at these very high prices? Let's go back and take another look. And so one example of that was the North Sea. So we've got here a picture of a North Sea oil rig that would have been built in response to those high prices. Okay, and you can see it's a nice sunny day, but obviously the North Sea is not a nice sunny climate. It's a very difficult climate. And not only that, you've got this very expensive hundreds and hundreds of millions of dollars spent on the oil rig. Then you've got to anchor it to seafloor. You've got to drill down to the seabed and then under the seabed and get the oil reservoir out of it. So one thing we know is when people did this, as the response to those high prices, the response involved very high fixed cost, okay, to build an oil rig like this, but very low marginal cost. Why? Because once I had that pipe into the reservoir, it didn't cost me very much to pump the oil back up. All right? Second thing we notice is this reservoir typically lasted for maybe 20 to 40 years. These North Sea oil reservoirs are just ending their useful lives right about now. So go back, and we can see here, in the second oil crisis, we had very high prices. One outcome of that was the world went into a worldwide recession. Demand for oil fell, and we had all this new supply coming on from these very low marginal cost producers. And that's why we saw this extended period as those producers trying to recover some of their fixed costs. They wanted to recover all of them, but they couldn't, and they're bidding into the market at that low marginal cost. Okay, so again, just taking that same concept of marginal cost and the relationship between marginal cost and fixed cost and applying it to a real market. Now, what's going on here, we see the prices going up and then dropping. Well, we come to the end of that 20-year period, and now demand grows. Now we have to find new oil. It's expensive at the margin, so prices go up, but then they drop. Are they going to stay down? Are they going to bounce around as they have in the past? Again, let's see how oil is produced, and that'll give us an insight. So this is a picture of something you may be familiar with. It's how North American oil is largely produced today through fracking. I put a pipe in the ground, I break up the shale, I extract the oil. And this is actually a good rendition here because this is a sort of puny little derrick on top. Looks like it's much less substantial than that huge platform rig we saw in the North Sea. And that's exactly what we should infer, that frack gas has a much, much lower fixed cost than the platform oil. It has a higher marginal cost because I've got to put water and sand to break this up, but the marginal cost is pretty moderate. The other thing to know about this is that when I do one of these wells, they only last for 12 or 24 months, not for a couple of decades. So if the price gets too high, I just don't put another one in the ground. If the price gets too low, and if the price gets too high, I spend a little bit more fixed cost to build another one. Well, that allows us to go back to a supply and demand curve for oil here. Again, I'm not trying to be accurate numerically here, but I've drawn the conventional sources of oil back in the 1980s. Maybe this is Saudi Arabia, this is Nigeria, this is Venezuela. They're all pumping out of reservoirs. We know that demand was about 60 million barrels a day. Now let's fast forward to the present, where we have higher marginal cost oil from North American unconventional. That's our jargon for fracked oil. But the one thing we know is there's a lot of it. And there's a lot that can be extracted at a marginal cost. We don't know exactly, maybe $55, maybe $60, but there seems to be a long, flat part of the supply curve. Well, demand has risen. We're about 100 million barrels these days per day. And what that allows us to see when we put this together is that it's highly unlikely we'll see substantially lower prices for oil. That would take a worldwide recession, which moved this demand curve back into that part of the supply curve. It is similarly unlikely that we will see large price spikes because we've got this flat part of the supply curve, lots of oil out there that can come on at $55 or $60. So again, what we've done is sort of convert our supply and demand ethereal concepts into something that actually tells us what might happen in the market. Okay. Okay, I'm looking at one of the questions here. How can the supplier H with a marginal cost of 52 make any earning to recover the capital cost if the price clearing is 52 and there's no significant change? Well, the answer to that is that supplier H must have, when he built the plant, been hoping for a variation in supply and demand that would give him some of that producer surplus, not necessarily on the day he bids that we looked at, but in some other day when we have a hot or cold day and the demand for electricity goes up. All right. Quickly, I want to make some observations to conclude here. The first, we've said it over and over again. A supply curve in a competitive market reflects the marginal cost of each successive producer, okay? In a competitive market, producers don't determine the price they charge. The market tells them the price. So a wheat farmer in a very competitive market never agonizes over what to charge for his bushel of wheat. He just looks at the commodity prices in Chicago or in the newspaper, and that tells him what's going on. If you hear a siren in the background, I'm across the street from the hospital, so I apologize for that. Setting your price to recover your full cost of production may end up that you recover none of your fixed costs. So we think about the right way to price is to get my cost and have a markup, but in fact, that may not be the wise way of pricing. And then finally, we learned that from both the Texas market and the oil market, high prices, even the expectation of high prices, can quickly attract new investment, and that erodes those very prices that were expected. And this is particularly true in a market where there are high fixed costs and low marginal costs. So let me say one more thing that's not on the slide. Electricity price markets are unusual, okay? And I think this answers a question that's just come in. Electricity is something, when you flip on the switch, you want it to be there immediately. Well, electricity is very costly to store, at least with present technology. That means that it has to be produced at that instant as well, and that means that the market clears instantaneously at every moment. In fact, we're usually at 5-minute increments. It also is the case that we can observe very easily the marginal cost of each firm because we know the technologies and we know the fuel costs. And finally, electricity is a commodity. So there's just one price that clears the market. Well, you put all that together, and it means that the dynamics of what happens in electricity markets are extremely transparent. We can look at them, and we can learn a lot about how competitive markets work. Now, you may say, well, look, I'm not going to be a wheat farmer. I'm not going to go into the electricity industry. Isn't that a little unusual? Are you sure these insights are more general than that? Well, let's take another industry. Okay, let's say you're in the automobile industry, and you're General Motors, and you're trying to figure out what the price of, let's say, a Buick Enclave, one of the cars they produce, should be for the year. Well, you're going to get your team together. There's no board or trading platform that tells you the price of a Buick Enclave. You're going to have to make a guess and put a price out there. And so that looks like it's very different from our competitive market because it looks like the marketing team at Buick is in control of that price. They are and they aren't, okay? Imagine what's going to happen as we go through the year. Let's suppose there were more competitors, there are plenty of competitors in the car industry, and they were also putting their products into the market. And Buick notices that there's a big inventory buildup of Buick Enclaves. Well, what's the response? They're going to tell their dealers or their marketers, look, you need to do some promotions. You know, the $1,000 cash back or the no interest loan, which are effectively ways of lowering the price. Now, it looks like they're in control of that price, but what they're really doing is reacting to those that same competition among suppliers to sell their product and recover some of the fixed cost of making those cars. It's a lot less transparent than electricity, but the forces are just the same. And the point of looking at these highly stylized markets is to make sure when you go into the business world, you're understanding that the dynamics are the same, whether I can see it clearly or whether I have to look behind what's going on and make some inferences that where the prices don't converge as quickly as they might and where I can't actually see those market forces in as easily a way as I can in electricity. Now, Nicole, could you go back to the question about, I think the question was about where can we get other information? Was that the question?
Yeah, so we had a question coming in that was asking about, are there clubs or activities that Goizueta offers its MBA students so they could engage in more of this type of learning around these financial concepts?
Okay. So the first thing I'm going to say, come to Goizueta and get an MBA and take the core econ course, and that's the main mechanism. But we have lots of clubs that some of them are industry specific. For instance, we have an energy markets club where we spend a lot of time on stuff like this, a lot of outside speakers. But we have other clubs that are, for instance, private equity clubs, and we have a finance club in which we're again applying concepts not quite like this, but more financially oriented to solution of financial problems. Nicole, should I go on or not? What? Are we running out of time?
We have about 10 minutes left on the chat, so let's go ahead and just go through some of these questions that came in. I'll go ahead and pick a few out for you. So we had one coming in that says, aside from efficiency achieved by newer plants, how does environmental costs, such as carbon offsets, impact the supply curve?
Great question. So that's, you can think about that, what we saw. Remember the Mount Tom coal plant? So they had new environmental costs that made their costs of production go up, and that's why they moved out of the supply curve. It's actually what I'll say here, it's one of the failures we have in our environmental policy. The easiest way to address issues of the environment are to put prices on the things that we don't want to go into the atmosphere. So we talked about a carbon price. That would be a very easy way of, for instance, encouraging. You saw at the bottom end of the curve, you got a hydro plant, which doesn't emit any carbon dioxide. You have a nuclear plant, which doesn't. And if you imposed a carbon tax on the gas-fired or the coal-fired or the oil-fired, their marginal costs would go up. They would have to pay for each ton of CO2 that they emit, and that would provide more producer surplus to come in and reward people who built the plants that were cleaner. Typically, the plants that are cleaner, wind, solar, nuclear, hydro, all have much higher capital costs than a gas-fired plant, and so that's why it's important to put the cost of the let's say CO2 that the gas-fired plants into the market as a market signal to encourage greater investment in those cleaner technologies.
Terrific. Okay, another question that came in, what about underpricing in order to gain market share?
Well, the question there is people always talk about it, gaining market share, but the question is why? In other words, let's suppose I priced below my, remember what we're saying is everybody is going to price at their marginal cost. If I price below my marginal cost, that means that what I'm doing is making less revenue than it costs me to produce each incremental unit, so I'm losing money on every unit I produce, which isn't going to help me earn a return or anything else. Again, it depends on the market you're looking at, but in the long run, my market share strategy has to come back with you have to explain why in the long run I'm going to earn more money in the future by incurring that loss now. In a commodity market, okay, it makes no sense whatsoever because I'm going to come back the next day, and even though I will have run at a loss on day one, I'm going to come back and there'll be a new auction on day two, and my ability to earn a profit in that market is totally unrelated to whether I underpriced in the day before. So in competitive markets, the idea of market share really doesn't make any sense. And even in most markets, I have to think very carefully, what am I giving out up in the short run? Tell me how it's going to increase the profit margin in the future, because I'm not doing this as an act of charity.
All right. Another question for you. What pricing strategy do you think is used for a commodity such as gold?
Oh, well, the answer to that's very clear. None. Okay. Commodities, again, I can look up and I can see what the price of gold is on the exchange. And a producer of whether it's gold or electricity or wheat has no pricing strategy. They say, what are my costs? What do I expect to see as a price by the time I'm able to produce my output? Is my cost of production greater or less than the price I'm seeing in the market? But I don't get the luxury of a price strategy as a gold producer because there's a liquid market that tells me exactly what that price is. If I go and I say gold, what is it, $1,300 an ounce today? If I were to go to the market and say, look, I'd like to sell my gold for $1,350, nobody would buy it because they'd say, wait a minute, there are plenty of sellers at $1,300. If I go and say I want to sell it at $1,250, why? Because I can get I can sell as much as I want to at that $1,300. So this is hard to imagine, but the more competitive the market, the less I even worry about price strategy because the market is telling me what my prices are.
All right, another question for you. Are there markets where the supply-demand curve is less correlated than electricity and oil markets? Stock market comes to mind where higher prices tend to raise demand for stocks and lower prices tend to reduce demand.
Well, I think we're asking a different question here. We're saying, do I have markets? You're really saying most markets are characterized, all markets I would say, by a downward sloping demand curve. Okay, so the higher the price, the less I demand, the higher the price, more. I think it's unambiguous that we have upward sloping supply curves. The higher the price, the more supply comes into the market. That's even true in the stock market. Firms tend to issue more stock when stock prices are high. I think that when people think about, for instance, higher prices lead people to invest in the market, so higher prices lead to increased demand for stocks, I think that's just a short-run illusion, actually. What we're seeing is some momentum effects in those markets, but it's very hard to imagine a typical market where if I raise the price, demand for my product goes up. And I would say in particular, if you're thinking about going into business somewhere and you have the idea that somehow you can increase your customer satisfaction and customer demand by raising the price, I don't think you're going to be very successful at the end of the day. You may want to raise your price for other reasons, but it's not to attract additional customers.
Ray, we have a question that's actually about the classroom learning environment. And okay. I know here at Goizueta, we talk a lot about experiential learning. We put a lot of emphasis on that, on team-based learning, project learning. Maybe you can answer from your perspective. Do students get the opportunity to work on projects and put learning into use?
Okay, so the answer to that is that we have lots of opportunities for that, and they vary widely across the topics that are being taught and the professors that are teaching them. So for instance, my core economics course, first of all, it's a half semester course. We're trying to learn some core concepts. We have team problem exercises where teams work together. Whenever I have a very complicated problem, it's usually a team problem. And some of those are, I would say, one remove from being a real world problem. They're all based on sort of real data and real events, but they may be things that have been simplified. In the course I'm teaching this spring, which is a project finance course, so it's how do we finance large projects, students, everybody the whole class divides up into teams, and one of the semester-long exercises is actually to find a project. It could be a real one that's happened in the past or one that's currently under construction. For instance, we had some students who worked on the financing of the Braves' new stadium here in Atlanta, and to say, how is this financed? How was the capital attracted? What are the economics of it? And so there are lots of opportunities to do that in the school. In fact, I don't think we'd be a very good business school if we didn't have lots of opportunities.
All right, thanks, Ray. We are actually out of time for today's session, so thank you everyone who submitted questions. Thank you again, Ray, for delivering such an engaging class. I'd like to let everyone know that we have our next monthly web chat. It's March 21st, and we'll be talking about leadership opportunities here at Goizueta and our leadership curriculum. So please join us for that. We'll be sending an email out to everyone to give you an opportunity to register for that. So thank you again, and enjoy your day.